Welcome to part one of a four-part series titled How to Lose Money in Cannabis Stocks. So, this is the $1,000 problem, and this is what I see a lot of new investors coming in, and they've got whether it's $500 or $1,000 or a smaller amount of money that they're looking to invest. This is the mistake that they make. And so, this is a four-part series. There's going to be four different videos with four different problems, and at the end of part four is going to be what I consider the solution to avoiding these four pitfalls that a lot of new investors fall into. So part one, the $1,000 problem. Diversification is a really important thing when it comes to investing. But the problem with diversification with a smaller amount of money, like $1,000, is if you're working through a bank, if you're investing through a bank, say TD, for example, they're going to be charging you $10 to buy and $10 to sell. So a lot of advice on the forums and on the internet for new investors in cannabis is to pick the big three, pick Canopy, Aurora, and Afria, and divide that up into thirds. Unfortunately, you're going to lose 6% right off the top. So you're going to lose $60 on trading fees out of your 1,000. So if you go to a financial advisor, if you go to any of these institutions who are going to manage your money, 6% or negative 6% might not seem like that much, but these guys are considered heroes if they give you a 7% return, say, over an annual basis. So in the beginning, losing 6% right off the bat, especially if you're new, is not going to be a good move. What I would recommend is to go with an ETF like HMMJ, Horizons Mutual, and you're going to get a piece of a bunch of different pies, and it's only going to cost you, one transaction or two transactions to buy and to sell. Now, they're constantly updating their holdings. If you go on their website, you can see who they own, and then you own a piece of those companies through HMMJ. So they're doing the legwork for you. And then once you're in, your ability or your motivation to do research on these companies is going to increase tenfold. And so that's a really good jumping off point, because then you can go into these companies, dig a bit deeper, and then in the future, you can invest maybe on a one-to-one basis with these companies after you've done your research. But if you're looking to just jump in quite quickly, this is the safest bet, not only for your fees, but also for diversification of risk. And this is just a really healthy way to start investing. And we're going to go a lot deeper into different investment strategies, different stocks, what strategies mean, what to follow, what to look for. And we're going to go deeper into the problems that new investors face. But the easiest way to get over this first hurdle, this first $1,000 problem, is to not diversify, because that's something you're going to want to do later on down the road when you have more knowledge and when you have more capital to use in your investments. So thanks for watching. Make sure to subscribe and stick around for part two.